Hello everyone and welcome to this week's FX webinar. My name's Craig Erlam, Senior Market Analyst at OANDA. As you can see from the headline of the webinar, there's very much going to be a focus on Brexit. Now, I personally am very much hoping that not many more of these will be necessary. The 29th of March exit date now is looking very unlikely, but all being well in the next 10 days, it will at least be a marker, a point whereby negotiations no longer take place and technical legislative agendas will need to be passed. That isn't market moving. That isn't even newsworthy, I don't think. So hopefully we are still on the 10-day countdown, regardless of what we're seeing at the moment. And despite all the noise, despite all the political wrangling, I'm very optimistic, shall I say, that we are still heading for that particular deadline, but the actual technical Brexit day will then be put back until the end of May or June. At that point, it doesn't really matter, I guess, as long as there's a deal in place. However, we will come back to that shortly. Firstly, allow me to introduce myself. I am Craig Erlam. I'm Senior Market Analyst at OANDA, based in London, so very much being at the heart of all of the Brexit negotiations, all of the Brexit nonsense, you may say, for the last few years. And it has been quite the ride. It has been quite dull for the vast majority of those times. I now know far more about parliamentary process than I ever wish I needed to, and I know far more about various other things like borders and processes there than you would ever wish to know. So the good thing is that it does seem that we are hitting the end, and I think this is really where it's now getting interesting, because we're not just seeing the boring details unfolding. We are very much seeing political strategizing at work, and it's almost like I've said before, it's almost like a TV series that we're watching unfolding before our eyes. We seem to think these political dramas are all based on these made-up scenarios, but it's times like now that we start to see the reality behind it, I guess. And I have very much become a cynic throughout the last 6 months in particular, but probably longer. Every time something happens, I'm seeing it through the eyes of who does this benefit most, rather than who's necessarily saying the words. And it's because of that I'm still confident. I'm still of the belief that we are still exiting, or we're still going to have a deal in the next 10 days. I'm not in panic mode just yet, and I don't think I'm alone. You'll see from a number of these sterling charts, which we're going to show up shortly, that traders are really not worrying at the moment. Obviously, the major downside for sterling comes from a no-deal Brexit. That's the one that has the potential to cause chaos. That's the one that has the potential to bring with it severe economic consequences, and I stress potential there, because we don't know exactly what it's going to be. It's quite clearly going to have a very disruptive impact. We can't know for sure exactly what that will be, but that's the outcome that I guess traders do fear most. Now, that has been eroded away over the last few months, and I think the vote last week clearly signified once again the lack of appetite Parliament has for a no deal. The important thing was that it wasn't binding. So after the vote, when everyone was saying, or when many people were saying that no deal's now off the table, that is not technically true. It means that no deal is very, very unlikely, but it doesn't mean it's off the table just yet. The simple reason being that if on the 29th of March, if the UK has not secured an extension from the EU, and the EU and the UK has not backed a deal that's been agreed with the EU, and the UK hasn't withdrawn Article 50, then the default option remains for now that on the 29th of March, we leave without a deal. So therefore, no action leads to no deal still. And that's why I don't think there's too much devastation from Theresa May's team on this particular defeat, because she knows that the threat of no deal is still there, and therefore the negotiation, that one piece of leverage which she's clung on to all these months, remains intact. So while that remains a negotiating tool, it still remains a very unlikely option. And that's, I think, one of the reasons why traders are not getting too carried away with all the hysteria that we're seeing at the moment. But there is still a lot of drama unfolding, and I still think there's plenty more twists to come in the next 10 days. Take this week, for example. This week we have a vote, or we're meant to have a vote in Parliament. It was initially meant to be today, on Theresa May's Brexit deal, a third vote on her deal. Now, yesterday, John Bercow, the House of Commons Speaker, came out using a precedent from a rule from 1604 to block any vote on Theresa May's deal unless there's significant change to the deal, effectively saying we can't keep having a vote on the same deal over and over again until you get the desired result. Now, that's caused a lot of controversy. One, because he's a very controversial character as it is. Two, because he's taken steps throughout this process which people have deemed to be favouring certain outcomes, and also stressed previously that past precedent shouldn't necessarily dictate this process. So to make these two, say that previously and then act on a rule from 1604, a rule that I believe hasn't been used for around 100 years, very much goes against that. But again, the cynic, the skeptic inside me wonders just who this benefits most. And while this is being sold in the media as a big John Bercow, Theresa May's adversary, ruining the potential for a deal, blah, 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 I actually think she stands to gain the most from this. This is a vote that there's been no suggestion that she's convinced the DUP yet to take side. That's the Northern Irish ally of the Conservative Party. And therefore, there's no guarantee that she's actually convinced the more hardline Brexiteers in the ERG to support the deal either. And without those numbers, she simply can't get this through Parliament. So who does not having a vote actually benefit most? Well, for me, it's Theresa May, because it means that she can now go to the European Council summit on the 21st and 22nd, so this Thursday and Friday, and she can say to EU leaders, I took what you offered previously. It failed. It failed miserably. We lost by 149 votes. And it was one of the largest defeats ever in Parliament. I've tried to convince my fellow MPs. I've actually succeeded in convincing some, not enough. And I've now been blocked by Parliament from having another vote unless something significantly changes in the deal. So she's effectively now able to put the ball back in the EU's court and say it's out of my hands. Unless you offer something, then my deal is off the table. And that all we're left with then is a long extension or a no deal. So we need to think long and hard about this, and especially if she comes with an alternative proposal or an additional piece of legal text. We have to remember that in politics, 10 days is an awfully long time, and a lot can happen, especially a lot that's been prepared. And I very much am along the wavelength of this has been prepared. That this is not something that Theresa May and her team have been caught off guard with or unprepared for. I think we'll learn a lot more after the European Council meeting later this week. There is suggestions that they won't even offer an extension later this week, that they may wait, put the ball back in the European Parliament, in the UK Parliament's court, and insist that they agree what the extension's for before agreeing to any extension. Again, a lot of games here. But all of this suggests that this is going right up to the wire. It always was going up to the wire. At one stage, back in October, I was surprised that the UK and the EU actually reached a deal with plenty of time to spare. So it was very uncharacteristic of both. And as it turns out, it was never meant to be straightforward. And that was just one hurdle with many more lying ahead. So that's where we are this week. This week, we are in a situation whereby a vote on Theresa May's deal looks unlikely. It's now down to the European Council to decide what option they take. For me, and this is always changing, so it may not be the case, but for me, there's kind of three options now left on the table for the European Council. They either put the ball back in the court of the UK. They can offer a long extension and say without a deal on the agreed, then we can't offer a short extension. Or they could try and strong arm the UK, which is a good negotiating tactic from their perspective because they very much hold the leverage at this moment. But it's very politically sensitive, shall we say. And they say you can have an extension for 3 months on the condition that you accept my deal. You accept the deal that's on the table and you can have an extension, otherwise no. I'm sure a fourth option will appear because if there's anything that this Brexit process has done so far, it's thrown up surprise after surprise after surprise. But that is kind of where we find ourselves. Now, the important thing is from a market's perspective is where does that leave us with no deal? As I said, no deal is very much still the default option on the table. But the route to that is very challenging. As I say, if MPs in Parliament are strongly against no deal and the numbers and the votes and etc. suggest that they very much are, then this is not something they will back. And therefore, if it looks as though we're heading for a no deal at the end of this month, I believe every effort will be made to change what legislation has passed previously in order to avoid it. And I believe those plans are already in place, whether they've been publicised or not. I don't see this accidental no deal ever materialising. So for me, the only route to no deal that's feasibly on the table is via a second referendum. And this is where the EU comes back into this. Because if the EU attempts to strong arm the UK, they do risk angering the public at a time when a second referendum is a possibility. And we've seen how much of an impact, how much emotion can play in these referendums. So it may be a tactic the EU actually try to avoid at all costs. Because if the vote comes back and it's Theresa May's deal, remain or no deal, or just two of the three, this is the most likely way, and in my view, really the only way, that the risk of no deal actually is real. And I think that's when you'd start to see the markets respond. But for now, they're very calm, they're very assured. I wouldn't be surprised if as close we get to exit day, that volatility very much picks up, especially if we're no closer to a deal. And I wouldn't be surprised. It'll be a very big test of sterling bull's nerve the closer we get as well. So it's definitely going to be interesting to see how this materializes. But as again, you're going to see, I feel like we're trading very much at its upper end of the trading ranges where we're at now. So what that means is A, traders are confident. B, I think the upside may be fairly limited, not entirely limited, but fairly limited. And because of that, the downside risks in the event that the unlikely unfolds remains quite severe as far as I'm concerned. And again, this very much reminds me of the referendum night. In the lead up to the referendum itself back in June 2016, the markets were very much convinced that we were going to see Remain victorious and clearly. And we saw the pound rally very much into that. And we can show this on a chart here, actually. Let's bring up a chart. We've had a static screen for way too long. Unfortunately, when we're talking about Brexit, we're talking about the processes and we're talking about what's coming next, there isn't exactly many visual diagrams that I can throw up. Now, what we've learned throughout the last number of months is everyone loves a flow chart. Some of them are useful, some of them are garbage, but they all expire really quickly. So I never see any much use in a flow chart, because once you start to add to it, even in the slightest bit, the rest of it can make much less sense, or it can overcomplicate things. I find that flowcharts are an attempt to simplify a process which is far from simple. But without that, and without charts, we don't really have anything visual. So apologies for the fact that the first 15 minutes of this has just been me talking without any visual aids or anything like that. But there isn't really anything interesting to put up on here. to make this any easier. Unfortunately, as I said, a lot of Brexit has been dull so far, and it's about not necessarily understanding the in-depth processes from everyone's perspective. Unfortunately, in my job, I've had to learn more than I would otherwise like. It's about just understanding what's coming next. And what we know is coming next is A, the European Council meeting on Thursday and Friday. B, at this moment in time, exit day 10 days from now. And possibly C, a vote on Theresa May's deal at some point. And everything else is really up in the air. And that's what's going to make the next 10 days interesting. That's when we start to see the real crux of the politics being played. But like I say, back in June 2016, we very much saw the pound rallying in the days up to Brexit Day, up to the referendum. So much traders were convinced that we were voting to remain. And for those of you who were trading at the time, you'll remember that the reason behind this primarily, interestingly, was because of the betting odds. So people were looking at the betting odds. It was interesting to just see so many people looking on various betting websites that were taking punts on whether we'd vote, leave, or remain. And they were all showing 90+% chance of remain. And you could literally plot the percentage chances versus the pound at that time. And they mirrored each other perfectly. So there was obviously a lot of speculation then afterwards about whether there'd been any, not by the betting companies themselves, obviously, but whether there'd been any, I guess, what had led, which had led which, and to what benefit, I guess, because the numbers were clearly incorrect. It wasn't truly reflective at all, and it was far too confident one way. And what we saw was the pound trading up around 150 against the US dollar, and then later that day as low as 132. We're not at that extreme, I don't think, but we're very much in a confident mindset right now. I mean, we're now up at around the kind of 133s. We haven't hit the 144 heights, we're near 144 heights that we hit back in April, but there's been a big dollar play in this as well. Like we've got to remember that this isn't a pound chart, this is pound versus the US dollar. But I think there's a strong confidence here. So the downside risk potential, I think, is quite severe. I think the upside potential is much less so because of how much is priced in. Like I say, at the moment, I think no deal is largely priced out, which and when you're going from the kind of along the spectrum from no deal at the hard end of Brexit to remain at the soft end, Theresa May's deal is very much more towards the softer Brexit than it is towards the harder Brexit. So the gap between no deal and Theresa May's is significant. It's huge. So markets are pricing in soft Brexit and up. And like I say, that leaves it vulnerable to downside moves if things materialize in a different way. But I think right now, traders are quite settled, quite okay with what's going on, ignoring the theatre, ignoring the drama, and just sitting happily on their hands, waiting to see how things play out. So in terms of where we stand, in terms of cable, for example, we're still between the 130, 133 range. We've been here for quite some time. We did peak above these levels at times, but we saw a bit of profit taking, which dragged it kind of back inside. But you can see following the most recent bit of profit taking, for example, this is very much just consolidation. We've not even come back towards the kind of 131s. We've stopped at 132 and we've edged a little bit higher again and tested the kind of 133s again. I still think this is still a very bullish market. I think for things to go below 130, we'll have to get a little much. For example, if we get much closer to Brexit Day, if the EU Council summit goes badly, that could take us back towards these kind of lows. But ultimately, if Theresa May's deal gets over the line, then 136 becomes a notable level as far as I'm concerned. It's a previous high. Even these kind of 138s where we were trading lows previously is potential. I'm not. Like I say, given how much is priced in this at this moment in time, it's hard to see this very dramatic upside move unfolding, if I'm honest. In terms of to the downside, I still don't see no deal as being feasible. So at the moment, to try and speculate on what kind of an impact that could have on price seems a bit insane. And also, I've seen so many forecasts now floating around from various places about where the pound, for example, cable is trading in the event of no deal. And the range is huge. This forecast from 115 through 125, 130. At the end of the day, it just goes to show that this is all matter of opinion, and it's all when you're speculating on an event like this, it's all guesswork, and it's not something I necessarily want to engage in. I'm looking at interesting key levels here. 130 is a key level to the downside. 127 is a congestion level below there. 124, 125 below there. Now, obviously, in the event of a no-deal Brexit, to think that we could be trading around the previous lows that we've traded at, it's not an aggressive forecast, shall we say? I hate the word forecast. It's not an aggressive projection. We've traded there previously on the risk of no deal. So I don't think that's overly aggressive. In fact, I think it's probably very conservative. But that doesn't mean I want to simply just go and pick a number out of thin air and say this is where we're going to be heading back towards. For now, though, market remains bullish because we're at the highs and we're consolidating. And we're seeing that in a lot of different pairs as well. If we look at Euro Sterling, for example, Euro Sterling was quite interesting because we actually broke through the range. After all this time, we finally broke through the range. Now, as I say, in these situations, you are trading two currencies off against each other. And I think the weaker euro has had a major role to play within this breakout rather than just Brexit itself. But again, as we've seen with cable and as we're going to see with a number of other currencies, the sell-off is losing momentum. I still think this is the important support here, around 83, 84 kind of levels. That's where we've run into support previously. It's where we were finding support after the referendum sell-off in the pound itself. We broke through these these 83s, and we've never really traded back below there again. It's where we actually ran into resistance almost immediately after Brexit before a little bit of consolidation before we then carried on breaking higher. So this remains a big area of support as far as I'm concerned. We found some temporary support here around the kind of 85s. You can see that we've seen some short-term support and resistance in this kind of area here, and even going back a little bit further. But more importantly, like I say, momentum. You can see on these indicators at the bottom, we've got the MACD here, the MACD moving averages and the MACD histogram, both seeing rising lows at a time when price is seeing lower lows. The same is true on the stochastic. This is what's called divergence, bullish divergence, when your momentum indicators are not confirming the price action. So that suggests to me that the trend's weakening. It suggests to me that a lot is already priced in and that we're just almost waiting for that final confirmation point. And for that, we may have to wait another week or so. So don't be surprised if we do see further consolidation in these areas. If we don't, then again, 83, 84 is still key. And I will be paying close attention to those momentum indicators once again. Because ideally, when you see a trend, when you see a strong trend, you want momentum to confirm the price. And momentum hasn't confirmed price for some time. Sterling CAD is another interesting one because we've been seeing this uptrend materialize for some time. Now, this is the pound rising against another currency, which is, on the one hand, doing quite well because we're seeing gradually rising oil prices and they're a big oil producer. And therefore, the correlation between the Canadian dollar and something like oil tends to be quite good. The flip side of that is the economy, like the US and others, is struggling. The central banks become less hawkish. and that could be potentially contributing to the softness. I actually think the Bank of England, for example, in the event that we do see a positive Brexit result, by that I mean one that is positive for the economy, whether that be Theresa May's deal or whatever else. But if we see a positive Brexit result, then I think the UK Bank of England could actually be one of the few central banks that raises rates this year, and maybe even more than once, depending on what kind of bounce back we get. I think they're keen to already. We saw the jobs data today, which showed that unemployment was at 3.9%. I think that was the lowest since 1975. Wages were growing at 3.4%, which is well ahead of inflation. And yet interest rates are still below 1%. So I think we've got the Bank of England here that is looking at a situation whereby the economy could get a boost at a time when the labour market's tight, and may jump at the opportunity to do something that ultimately it wanted to do a couple of years ago. So that could be a supportive factor for the pound as well. But what I like about this chart really is that we are seeing a gradual series of higher lows. We're also seeing a gradual series of higher highs. The momentum is not more recently as we're losing some momentum, as you can see by the histogram, and as you can see by the moving averages, and as you can see by the stochastic. But again, we're doing it back at range highs, so we're waiting for that little bit of confirmation, but we're not breaking through 174 yet, 173.50, so therefore we remain bullish. What's interesting about this level here around the kind of 176.50s, 178 range is that this is previous peaks of support and resistance. And then you look at this internal trend line. Now, I've mentioned this on the webinar last week. I'm not a big fan of internal trend lines, usually. But what I just like about this is it's more of an internal trend zone. We've got the low here and then rising. Again, it's just basically covering all the supports that we've seen materialized throughout this time. And then it's got resistance here, it's got resistance here and here and here and here. So that struck me as being an interesting line. And then when I added that, I wasn't particularly satisfied because I noticed that it was missing a bunch of points as well. So I did a second line and I dragged it up, so it's parallel to the other one. And again, it's imperfect, but it covers all of these points. And it's like everything else I do, as you'll notice with my thing. I'm not really interested in single specific levels. Yes, we've got 166 here, but overall, I tend to be more interested in trading zones. What are areas, zones of support and resistance? Why are they support and resistance? Is it more significant when they're areas because of how traders react? Because let's be honest, this doesn't have to be a case of, well, I actually found resistance at 164.23 and therefore it's got to rotate off there again. It's about how traders and price responds to those areas. And the good thing about using areas is you get to find further evidence to support your view. So, for example, you're approaching a trading zone and you start seeing momentum slipping off. You're not going to see that as you approach necessarily 178.23 or whatever. So it gives you for me personally, it gives me comfort to know that while we're approaching zones and areas that have previously been interesting, it's interesting to see how price responds in the run up to and as we enter into them. So now if we look at this as more of a zone, we can actually see a number of occasions, and it's not a wide zone, we can see a number of occasions where prices approach these zones from above and below and found support and resistance. We're back in that zone now. So that's what interests me, especially given that it coincides with a prior support and resistance zone here more recently. And that's where we've run into resistance again. That's where we've started to lose momentum again. If we break through there, and I think we'd need to see a major step forward. If we break through there, then I think that would be a very bullish signal for the pound against the Canadian dollar. And when that materializes, I will have to wait and see. Like I say, I'm optimistic that we'll get something done. 10 days and counting. But I think this is a really interesting pair. And I think the fact that we've seen this continual series of higher lows very much supports the bullish view. But again, I need to stress this. Because the market's so optimistic, and I really truly believe it is, the downside potential is far greater in my view than the upside potential. But again, I would also stress that, in my view, the probability of no deal is far, far slimmer than that of a deal. So now I'll cover sterling yen. I'll then take a look at the FTSE 100, otherwise known as the UK 100 on our platform. And then I'll take any questions that you guys have got. Like I say, this is meant to be an interactive webinar. I'd like to stick to Brexit if possible. If we've got some time at the end, if you want to cover anything else, then I'll more than happily do so. But any questions, Brexit related, any Brexit related charts you want me to look at, for example, Alexander's asked about one, then I will, of course, take a look. That is the point of these webinars. It's to get more interaction. So please do send them through, and I promise to look and answer anything that I possibly can. So sterling yen. This looks like a very familiar chart. Looks very similar to a number of others that we've looked at. We've got the pound having risen from its lows. We've got the pound trading at its highs. This is a long-term range here towards these kind of 148 through 150 zone. We're looking at year-long peak. The trend is very much with the bulls, but we are running out of momentum. And we're running out of momentum because a lot of the positive Brexit news is priced in, and we're waiting for the rigmarole of the political games and the political back and forth and all of that rubbish to play out. Like I say, 10 days and counting. Very much delighted, touch wood, that 10 days is all we have to deal with now of this. But like I say, should be interesting 10 days. And it should certainly be interesting for the pound, and I think that's all we really care about. We're trading at the top end. We are losing momentum on the histogram, on the MACD moving averages, on the stochastic at a time when price is moving higher. But we're not seeing big cutbacks yet. We're not seeing big corrective moves yet. At the moment, on this, for example, we've seen consolidation. So that suggests to me that the market remains bullish, even if momentum is not necessarily with the move. Now, these things are imperfect because we've only got 2 points of contact, but you could look at that as a falling channel, or as some kind of falling wedge. Whoops. For me, it doesn't really matter which textbook shape it falls under. It's consolidation and it's bullish. But what we need to make this entire thing more bullish for me is we need to see a breakthrough this area, and we need to see momentum support the move. So I would say for this, because of my Brexit position, my view on where we're going, I would say I'm medium to long-term bullish on this. Again, to further stress, I think the upside potential is a lot smaller than the downside potential, personally, because of where the market stands and where we stand on Brexit. But I think medium to long term, the bullish potential there is. I would say this continues to look bullish. But near term, and I'm talking especially for the next 10 days, there is potential for some downside, some corrective moves to materialize. Because, and I've said this before with euro sterling, so I could very clearly be wrong. I personally can't see us breaking out through this 150, for example, until it becomes very clear that Theresa May's deal or otherwise is going to be agreed with the European Union. And I think an alternative deal will take much longer than that. Possibly if the European Union offers a long extension, that can be seen as being bullish for the pound. You could argue to the flip side that this prolongs the uncertainty, but I think ultimately the most bullish thing for the pound right now is that the most bullish realistic thing, the most bullish thing for the pound is that the UK decides to change its mind and remains in the EU. It's the most economically beneficial in the near term. But the most bullish realistic option is now that Theresa May's deal gets over the line. We just have to wait a little bit of time. And in that time, we may see some profit taken. We may see a bit of a corrective move. There's two things we can look at here. One is this rising trend line speculatively. It's only got 2 touches and a third near touch. But really, it's this area here through kind of 145.50, 144. Numerous points of support, moving averages, and it's where we start to come in contact with the cloud again. That's the area that I find interesting. I feel like if we break through this kind of 144, then that would spell danger for me. For one, we've got a double top formation here from a purely technical standpoint, 148.50 back through 144. A breakthrough here would suggest to me that there's significant downside potential back towards these kind of 139, 134, 140s kind of areas. I feel like one of two things has to happen for that to happen. One, there has to be a significant shift in the Brexit talks, which creates enormous uncertainty. It doesn't necessarily have to be no deal, but creates enormous uncertainty. The other thing is that traders would have to very much lose their nerve. So say we're on the 27th of March, we're 8 days from now. There's no deal on the table. Parliament's done nothing to take actual no deal Brexit off the table. So it's the default. And there's chaos. A lot of hysteria. Maybe that could be enough to test the nerve of traders and get that kind of shock value in the pound. And again, that's where your downside risk really comes into this, because when you start to see that unwind, then the hysteria can actually create hysteria. They're the two big downside risk factors for me right now for the pound as we approach that day. And I think breakthrough 144 would be a signal of that. So they're the big levels to the downside and the upside for me when we're talking sterling yen. And then we have the UK 100, the FTSE 100, the UK index. Now, what I've said about this previously, it's interesting. There's really two driving forces here. You have how equity markets are trading right now overall, and they've been a bit stable over the last few weeks. We've seen a few positive days recently. But really, as you can see here, actually, since the start of February, very much been in consolidation mode. US has been a bit better off, but we've been very much in consolidation mode, broadly speaking. The other factor playing into the FTSE is the pound, because, and again, I haven't checked the number very, very recently, but depending on where you read, around 3/4 of profits for FTSE 100 companies are actually generated abroad in foreign currencies. So what that means is that while the FTSE 100 is a UK index, and it may have a number of UK companies in there, it's very much not a UK-centric index, in that it's not necessarily representative of the UK economy, it's more representative of the global economy. And what that means is that when the pound weakens, the FTSE actually can do quite well. The pound responds to the economy and threats to the economy and tailwinds for the economy, and the FTSE can react in the opposite way. So, for example, in the aftermath of the Brexit referendum, as we see here back in June 2016, the initial response, and you'll remember we sort of saving US indices after Trump won the election, was very negative because everyone was talking about it like it was a very negative event. So the shock factor rippled through the equity markets as well, rippled through risk appetite, triggered this break glass emergency scenario, and we saw significant downside. And then common sense prevailed, and people started realizing that if 3/4 of your profits are generated abroad in foreign currencies, and the pound is now worth 10% less than it was, then when you report those earnings back in pounds, that you've generated in dollars and euros, etc., your money is actually worth more in pounds than it was before. So this realization that a weak pound is actually good for at least near-term earnings for these FTSE 100 companies became a driving force. And all of a sudden we saw it rally and rally and rally and rally. That didn't happen in the pound, obviously. So the pound, in the weaker pound, started having a strong, the weaker pound suddenly is very strongly correlated with the FTSE, because we're talking about dramatic bouts of weakness and strength. And that's very much what we've seen now materializing. So in terms of where the FTSE is heading, I know this looks like a big range, this 7100, 7350, and it is, and it doesn't make me feel particularly happy about it either. But there's two ways you can look at this. You can say, I don't like big ranges, so I'm going to try and find a narrower range and try and perfect my view on this, so I can try and pick a very specific level. And if that's what you want, then that's absolutely fine. That's not how I personally like to look at these things. I like to look, as I've said before, for ranges. And you can see that going back to April of 2015, 7100 was a strong resistance during this period. It was then strong resistance again back in October 2016. And then when we finally broke above here, we started to see strong resistance around 7350. We came back, we tested 7100, we found support. We went back into this range, we found a few bits of resistance. We found support around 7100 again, and it goes on and on and on. When we broke through 7350 significantly up towards these kind of 7550, 7600 levels, all of a sudden 7350 is support. And it was support again. And then we broke back below here, support around 7100, obviously with the occasional pierce, and 7350 becomes resistance. I could go on and on and on. The point is that we found support in this area again. We broke below, we came and tested from below, we found resistance. Now we're trading back in this zone again. The point I'm trying to make here is I don't care personally too much about technical levels of support and resistance individually. Combined, an area is far more interesting. For me, the act of breaking through this entire area with momentum behind the move is very significant if we can achieve it. But as with the pound and as with other things, I feel like we're at the upper end of a major resistance zone right now. Momentum isn't supporting the move. We've got the fib on from the all-time highs to the most recent lows, so we're in the 50 and 61.8 zone as well. And we're 10 days from potentially a deal that secures Britain's near to medium term future from an economic standpoint. If we do see a significant rally in the pound on the back of this, then that could act as a weight on the FTSE. And I think this is why we're seeing momentum starting to drop off. What we have to remember is that the pound isn't the only determinant in the FTSE. It does still track the broader market, but what a stronger pound could do is lead the FTSE to very much underperform its peers. And we've seen plenty of evidence of that over the last couple of years. But like I say, I feel like we're in a relatively vulnerable stock market overall. So if we do start to see some vulnerability in the stock markets, and we do start to see some near-term weakness at a time when the pound's strengthening, then that could come as a detriment to the FTSE, to the UK 100, and we're trading back at the top end of these ranges now. If we do break through these kind of 73.50, 74s, then for me that's quite a bullish signal, because we've taken out various things there. We've taken out moving averages, we've taken out fib levels, we've taken out zones of support and resistance, and that would suggest we're looking at quite a bullish market. That could come back on the back of some sterling weakness. It could come on the back of a strong stock market rally. But if we do see that, then the immediate level for me of interest becomes this kind of 7,600, 7,500 kind of area. Again, here we're looking at this zone here, which coincides with this zone here as being an area that's previously been solid support and resistance. So naturally, it's going to be an area I'll be paying strong attention to again should we get there. And again, in much the same way, if we break through here, then this kind of 77 through 77.50 maybe through 79, 7800 through 79, you could even say. But this kind of area here, then we're obviously back at all-time highs. But unless we see some significant sterling weakness, then I think we need to see a significant bullish shift in stock markets. This idea that we're going to see significant sterling weakness or a significant bullish shift in stock markets right now feels, for me, a little bit far-fetched. So if I'm looking at this, I feel like the downside potential personally is greater than the upside potential because of my views on Brexit in particular. And then to the downside, these kind of 71, 70, 7,071, even 72 could be a kind of notable zone of support. And then we'll see from there, I guess. Again, multiple factors playing into this, Brexit being merely one of them. But at the time when we expect the pound to be very volatile, then I expect this to be volatile in kind. Now, again, please do send through any questions that you've got with relation to Brexit. As per Alexander's request, I'm going to have a look at sterling zloty. That's the Polish zloty, for those of you who aren't familiar. Naturally, this isn't one of the charts which I personally follow too closely. So there is no analysis on here at this moment in time. But I will, as always, have a look at the chart and give you my off-the-cuff thoughts on it. And I'm going to be quite honest, my first impression just by looking at the broader chart here is that we're looking at a very similar picture to what we're seeing everywhere else. So let me explain. We are trading at the top end of where we've traded for some time. I feel like the range we're trading within, again, these are just rough areas, but so we've kind of got these zones here, congestion zones, you could call them. And you've got the lower part of the congestion zone around here, around the kind of 495 area. You've got the upper end of the congestion zone here around the 515. And then you've got somewhere around halfway where we've seen common support and resistance here around the kind of 504s. But the point is that this is one wide congestion zone. I feel like if we see a break through the top of this congestion zone, then that could be very bullish. I feel like we've got the rising support levels, which suggests to me that this is a bullish market that's preparing for a positive Brexit result. Again, very familiar with what we've seen previously. The downside to this being that this is potentially taking longer than maybe than traders were initially hoping for. I'm wondering if we've got a bit of a rising channel going on here. So we've potentially got like a bit of a rising channel action going on here in the near term. But importantly, the MACD, the stochastic, momentum is very much slipping with every high that we make in a congestion zone. So that makes me a little bit nervous near term. That's not to say we can't make a new peak, but we saw what happened last time we made a new peak. We immediately reversed lower. That doesn't make me feel very bullish in the very near term. But like I say, with this process, I do think there's some potential upside for sterling still in the event of a positive Brexit result, but I do think it's far more limited than any downside. And I think what's interesting with all of this as well, and something I really want to highlight, is especially with regards to the momentum can change. So while I'm saying that momentum is slightly lacking on these moves, so it doesn't make me feel very bullish, it doesn't make me feel very bullish on the way current price action is going. But that doesn't mean that in the event of a positive Brexit result, that momentum can't pick up along with price, so that we can't start seeing new highs on price and new highs on these momentum indicators. It just means that as per under the status quo, if nothing changes positively or negatively for the next 10 days, 5 days, 20 days, whatever, it would suggest to me that the upside is going to be limited. But in the event of a positive Brexit outcome, all of this can change. Price can make new highs, and all of these can make new highs as well. And the picture starts to look very different. But in the near term, until we start to see some developments, this is looking a little toppy for me. That's not to say that we're going to see some significant downside, but it is just looking a little toppy for me. And much like I think it was sterling yen, we've got this level around this kind of 495s, where firstly, if we break the top side, this rising at the bottom of this rising channel, then that would suggest some near-term negativity or near-term bearishness for this pair. But this is the key level for me, this kind of 495.50 area, this previous low. Because once you start breaking here, then you're starting to see kind of these double top type patterns breaking, and that would suggest some form of bearish development. So that would start to make me nervous. But near term, all this tells me is that a lot of the positive Brexit news that we've seen is priced in, and that we're just waiting for something more positive to now play out going forward. So hopefully that's covered everything you were going to ask. The moving averages don't really tell us much because we've been sideways trading for so long. We've just seen congestion, we've seen choppiness, we've just played in between them. These moving averages, they're only useful primarily in a trending market, and that's an upward trending market or a downward trending market. In a sideways trending market, you'll always just chop between them, so they lose any usefulness that they would otherwise have. And we've very much seen that to be the case now throughout 2017 and early 18. Maybe if we start to see some upside materialize from this again, we'll start to find some use, but for now, not so much. What indicator did you use above the stochastic? Is that an RSI or a MACD? It's a MACD. The MACD moving averages is the red and the green, the fast and the slow. And then you got the MACD histogram, which is effectively a visual representation of this space between the moving averages. So between the fast, so when this gap widens, this histogram is higher to the upside. When the gap widens with the red moving average below the green, then this goes below the zero line, and so on and so forth. So what you're effectively showing is momentum as per the moving averages. You're showing, for those of you who know MACD, I won't go into detail about what actually makes the lines, because quite frankly, it's dull and it's about how to use them, I guess, which is the more interesting. But you can effectively see momentum in two ways. You can see momentum between the moving averages making new highs and lows, but you can also see momentum in terms of the gap between them. If the gap between them is starting to shrink, as you can see here, lower highs, and actual negative. So the gap between them is shrinking into negative territory. Then that's a display of momentum as well. So you've got effectively two momentum indicators in one, which is how I use these things. There are a number of ways you can use these indicators as well. MACD is seen as a combination, I guess, in many ways of a forward-looking indicator and a backward-looking indicator. So for those of you who aren't aware, you have backward-looking indicators with like your moving averages, which take obviously previous highs, which take previous levels and average them out over a certain period of time. So it's very much a backward-looking indicator. And then you got your forward indicators, which is your momentum indicators, which tend to give you an indication of what can come. So that can be the RSI as per the question. It can be the stochastic, which is this one below. Or again, you've got the MACD, which is almost a combination because of the way it's calculated. You do have dual forward and backward-looking aspects, which makes it a very handy indicator and one that I like to use, particularly when I'm looking for divergences. I'm looking for trend exhaustion. And signs of potential shifts, I guess. If there's no other questions, I will wrap things up here. There's 5 minutes to go, but I mean, quite frankly, I'm sure listening to my voice for 55 minutes has been enough for you guys. So with that, I will say I hope you enjoy the next week or so. I hope you'll join us for our next webinar in a week's time. I also hope you found this useful, and that if you've got any questions, you will reach out to me on Twitter. My handle is Craig_Forex, so you're more than welcome to do so, and I'll always try to answer any questions I can. In the meantime, please do check out all the content which we are producing, and that can be either the podcasts which we've created, which you can sign up to now on iTunes and wherever else you get your podcasts. There's OANDA Market Insights, which is the one I create every Friday looking at the week ahead. There's the OANDA Market Beat podcast, which has been created by a colleague in Toronto. And then there's the video. You'll find a recording of this on YouTube later on today. It'll also be available on the OANDA MarketPulse website, which you can see in front of yourselves right now. That's also where we post all our daily content, myself and the other analysts around the globe. You'll also find the economic calendar here as well, so you can check that out. And I think that I've pretty much plugged everything that we have pushed out so far. So on that note, I wish you all the very best of luck with your trading. I hope you have a fantastic week and weekend. I'll hopefully catch you all again in 7 days' time, where, fingers crossed, I'll be making some small comments on Brexit, because parliamentarians will have got their act together, will have come to an agreement, will have passed it through Parliament. The EU will have done their part as well. They'll have granted the short technical extension, and we can all move on with our lives. But maybe I'm just a little too optimistic. Thank you very much. Catch you soon.